If you want, I can show you that one more thing about the infinite ROI really quick.
This is a story about a dude named Lane. Then one day he went and tried to rent them out, and then he became one real investor man.
Yeah, this is, like I mentioned, like bank actually financing it for you. The bank does it all for you that way. Now, here's the prerequisite. You have to have a net worth of at least $2.5 million. And that's not like a credited investor net worth, right? This is like net worth including all your business value, which is always debatable. You can usually, most people undervalue their businesses from what they actually are valued at. Home equity, all of this counts. But if you have a net worth of at least $2.5 million, 5 million if you're over the age of 50, but if you have a net worth of at least 2.5 million, you can get the bank to pay your policy for you. So think of this as a separate strategy. The first thing I taught you was short term. This is like the first one with the infinite banking. This is all about how to create cash flow now and invest now. Think of this as like this infinite return pension plan in about 20 years. Not to mention banks paying your death benefit for you so you don't have to pay it yourself, right? This is great for legacy planning too, even if you're older. So banks pay the premiums for you. They pay the full premium. The cool thing is after about 20 years, you can start drawing an income of anywhere from like 50 to 500,000 or more a year, depending on your situation. So what happens is the bank pays your premiums. They charge you at LIBOR interest rates, and they'll pay you those premiums for 15 years, right? They're charging you those interest. And then after that, what you want to have happen, because of course in the beginning, cash value is less, while premiums are higher. But eventually what happens is the cash value catches up and surpasses the interest. You're basically creating arbitrage off their money because LIBOR right now is charging like 3.7%. If you're earning 5-6%, who cares? I mean, we're going to start passing them up, right? So after those 15 years, now you've got extra cash in there. You could pay off the bank, and all the leftover cash is yours to use for your own income. So just kind of show you a quick spreadsheet on an example of one of my clients. Here, the bank was putting in that $364,000. So they're putting that in every year for 15 years. And we just kind of projected the LIBOR rate. We put it at the current rate, but we kept jacking it up every year just to be conservative, right? Because we don't know, LIBOR rates could stay low and it would be great. It could be way better than this, but we just want to see what would happen if they did increase the rates over those years. And so they charge you the rate. You can see the end of your loan balance in year one, they charge about 30 grand of interest. So you have 394,000. Your cash value is only about 170,000. So you're upside down about 235 grand, right? The cool thing is your death benefit, even after the loan's paid off, if you were happen to die during these years, your death benefit's over 9 million, almost 10 million bucks. Now, as time goes on, now you see like at year 19 or year 20, they pay off the loan, right? The loan was like $10 million. You had 11 million. It gets paid off. Now you're left with, in that little column E there, $1 million. And plus you got a $7 million death benefit. So now you just leveraged the bank to use all the money. You put in none of your own money. You paid them off. Now you've got $1 million and $7 million death benefit. You start pulling off about 182,000 a year in income. So it's definitely not a short-term strategy, but for the right situation, especially if you're a higher net worth, this could be an awesome additional strategy that you use to say, hey, I wouldn't mind extra cash flow in 20 years from now and essentially pay nothing for it. That would be cool.
So for the people who are like, well, that sounds too good to be true. Like, how do the banks do that?
Well, they know that they're going to get the interest back anyways. For example, when you're upside down, they want some sort of collateral. So whether it's like a letter of credit from your bank, where the bank says, yeah, we'll create a line of credit for you that will cover that in case something happens. Like if you decide to cancel the policy, then that will cover their butts. Give the bank their money back with the interest and everything. I'd say that's the one negative from an investor perspective is, yeah, I mean, you got to have some collateral, some skin in the game there. But like I said, you can get a line of credit that can cover that from your bank, or you can even use like brokerage accounts. If you got money sitting in savings, you got brokerage accounts, you got money sitting there in savings anyways, you can use that as your collateral. And then the banks say, okay, cool, we'll loan the money. As long as we know we can get our money back, that's what matters.
I posted a couple of links, SimplePassiveCashflow.com/bank, where I have sort of a user manual